Hello and welcome to J. Mike Mortgage. I have 30 years of experience in the mortgage business. My name is J. Mike Perkins, and this is the second in my series on common mortgage mistakes and how to avoid them. And on this episode, bank statement problems. Most borrowers don't have a clue that issues with their bank statements could potentially get their mortgage declined or could cause them all kinds of problems that they could have avoided if they just understood how things worked. So I'm going to explain it to you. I'm going to go over this in two sections. Initially, I'm going to give you an overview of how the system works and answer questions like how many bank statements does the lender need, what are they really looking at, and what does it mean when your funds to close are seasoned. Then I'll give you three of the most common examples of bank statement problems that I see and how to fix them. I'm assuming that you're going to be applying for a standardized mortgage type, like a conventional conforming mortgage, an FHA Federal Housing Administration mortgage, or a VA Veterans Administration mortgage. Now, these mortgage types make up the majority of the market, but there are other types of loans out there, and their procedures may be slightly different. Regarding bank statements, mortgage guidelines do give the lender some flexibility. So what I'm trying to do here is tell you how I believe the average lender will handle bank statement issues. And of course, mortgage guidelines are always subject to change. And finally, if you enjoy this video and if you find this information useful, please help my channel by hitting like and subscribe and consider sharing this video. Let me explain how this system works. So how many bank statements does the lender need? Well, there's no simple answer and it just depends. To begin with, they're going to get some up front at the time of application. If it's an FHA or VA mortgage, they'll ask for bank statements for the last 2 months. If it's a conventional mortgage, they may get by with as little as 1 month. If the funds to close are in the beginning balance of the oldest bank statement that you supply the lender up front, and you're going to close soon, say in the next 30 to 45 days, then it's possible that these bank statements up front may be the only statements that the lender needs. But if the funds to close are somewhere else, they're not in this account, they're say in a retirement account or a savings account at another bank, then they're going to need copies of those statements as well. And if you transfer the money into your checking account, they'll need proof that it was transferred. They may need another statement to prove that the earnest money check that you wrote as a deposit when you signed the sales contract has cleared. And then finally, if you're building a home that's going to be done at some point in the future, your bank statements may expire after 4 months and you'll need to supply updated statements to get the final clearance to close. Now, here is something most borrowers don't understand. When the lender gets copies of your bank statements, they're doing more than just verifying that you have enough money in the bank to close on the home. They're going to look at the deposits that are on those bank statements. And if those deposits are clearly part of the funds needed for closing, they're going to verify the source of those deposits, and that has to be acceptable to the lender. Let me give you an example. Let's say you need $20,000 to close. You're doing an FHA loan, and the lender got copies of the most recent 2 bank statements. Let's say the beginning balance on the oldest statement was $5,000. Then, over the 2 months, you had $20,000 of deposits, another $5,000 of withdrawals, and the ending balance on the most recent statement was $20,000. In this case, the lender clearly needs to verify the source of the $20,000 of deposits because that's definitely part of the funds needed for closing. This is true because the money has not been on deposit long enough to be what the lender calls seasoned. So what does it mean when your funds to close are seasoned? Well, seasoning is just lender language that refers to how long your money has to be on deposit in the bank before the lender does not have to verify the source. Now, seasoning is generally defined as 60 days, but in practice, it's when the funds to close already exist in the beginning balance of the oldest bank statement that you give the lender. If you're having problems sourcing your funds to close, they can be fixed with enough seasoning. Here are 3 of the main bank statement problems and their potential solutions. Problem number 1, too many NSFs, that's non-sufficient funds, overdrafts, and negative balances on your bank statements. Now, there's no way for me to tell you how many overdrafts it takes to get your mortgage declined, because that decision is up to each individual lender, and they will have slightly different tolerances for such things. But if you have a bank statement that looks like this and has a summary toward the back that shows a huge number of overdraft charges for the month and yearly charges that are 3 to 4 times that, then that is the sort of thing that would most likely get your mortgage declined, and I would never advise you to turn in a bank statement that looked like this. So what do you do? Well, there are some solutions. You could open up a new bank account. Yes, that account would have to be open long enough to generate the number of statements that you needed to be approved for the mortgage, but that's a solution that would work. If you have multiple bank accounts and the other bank account doesn't have NSFs or overdrafts on it, you could submit those bank statements, and sometimes that could work. If all the money is coming from a retirement account, then you should submit a copy of the statement from the retirement account, because in some cases that may be all you need to do. And finally, if you have not had NSFs and overdrafts recently, say within the last 60 days, then you might be able to go to a branch of your bank and have them print a statement that covers either the last 60 days if FHA or VA, or the last 30 days for a conventional loan, because those branch printed statements, at least based on my experience, tend to not show a total overdraft fees charged for the year. And if they have your complete account number on there and your name, that should be acceptable to the lender, and that would solve the problem. Problem number 2 is so-called hidden debt that's not on your credit report, but the payment amount appears on your bank statements. When the lender goes to qualify you, they do what's called the debt-to-income ratio, and that is the other payments that they're going to count, plus the mortgage payment, divided by your income and expressed as a percentage. If that percentage gets too high, you no longer qualify for that mortgage. Now, in most cases, all of the other payments that the lender is going to count will be on your credit report, but sometimes there'll be something that's not. It could be something where the creditor is so small they don't report to the bureau, or it could just be some sort of error. But if the lender sees this additional payment on your bank statement, they may add it in to your debt-to-income ratio. If that makes it too high, you could have a problem and not qualify for the mortgage. So what should you do? Well, the first thing is to speak with the lender and make sure that this new payment that they're adding into your debt-to-income ratio really is your payment for additional debt that wasn't on your credit report. Sometimes the people operate under other names. It could be various reasons. Just make sure that that is actually the case. If that is the case, and this new payment is causing a problem with your debt-to-income ratio, then you should ask the lender if they would remove that payment from the ratio if you paid it down to 10 payments or less. Oftentimes, they will. If you're making a payment on behalf of somebody else directly to a creditor, for example, if you're making a car payment for a friend or a relative, but you make that payment directly to the auto lender, then the lender is going to see a new car payment that shows up on your credit report, and it's very easy for them to add that into your debt-to-income ratio. If that's causing a problem, you'll have to speak with the person who that account actually belongs to. They'll have to contact the auto lender, and they'll have to provide some kind of proof showing that you are not obligated to make that payment. If they can do that, the lender should not count that against you. Problem number 3 is when the lender can't verify the source of the funds to close. Then you have a situation where you have enough money to close in the bank, but the lender is saying you can't use it or you can't use some portion of it because they can't verify the source. The number one thing that causes this problem is large cash deposits that show up on those bank statements that you give the lender up front. Now, large is going to be defined by the lender, but typically it would be anything above about $300 to $500. The problem with cash deposits is they are somewhere between very difficult to impossible to verify. If you've got cash on hand that you need to use as part of the funds to close to buy a home, you need to deposit that money in the bank well in advance so it becomes seasoned and shows up in the beginning balance of the oldest bank statement that you give the lender. If the funds to close are coming from a paper check, something like an IRS tax refund check, an insurance settlement check, even your paycheck if you don't have direct deposit, and this is part of the funds you need to close, then I strongly recommend you deposit the entire check and don't take any cash out. If you need some money from that check, make a separate withdrawal. That way, the deposit amount will match the amount on the check, and it'll make things much easier to verify. Don't ever cash a large check that you need for the funds to close. Spend some of it and then deposit a different amount as a cash deposit. That's the sort of thing the lender will never be able to verify. If the funds to close are coming from a gift and the deposit of that gift shows up on the bank statements that the lender gets up front, the lender is going to request a copy of the donor's bank statement to provide a source for the money. Now, sometimes the donor just refuses to give that information out. If that's the case, you need to find that out up front, and you need to get that gift well in advance so those funds become seasoned, meaning that they show up in the beginning balance of the oldest bank statement that the lender has. If you do that, then the lender's not going to be concerned about the source of the money, and they won't need anything from the donor. And finally, if you're self-employed, I would recommend that you have separate personal and business bank accounts. That way, you don't have to try to separate the two of them out. If you're using money from the business as part of the funds to close, the easiest way to do that is to make those funds seasoned and deposit that money into your personal account well in advance so it shows up in the beginning balance of the oldest bank statement that the lender needs. Thank you very much for watching this video. I am a one-man operation and this channel could use your help. So please hit like and subscribe and consider sharing this video. On behalf of J. Mike Mortgage, I'm J. Mike Perkins. Thank you very much.